Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in Accounting, and our topic today is about liabilities, and one specific one called short-term debit financing. So, a lot of current liabilities, accounts payable, tax payable, salaries and wages payable, they are all from operations. Now, this one is for financing. So let's check here. Short-term financing options. The payment of an operating expenses necessary to earn revenue is called a revenue expenditure. Obtaining capital by borrowing money for a period of time is called debit finance. A bank loan agreement that provides immediate short-term access to cash is called a line of credit or credit line. And the interest rate charged to a bank's most credit-worthy customer is called the prime interest rate. So let's go to our Excel file and see how it works. So if you are a regular here, you already know that. If you're not, I want to let you know that all our Excel files, they are free, and the link to download it is in our video description. And by the way, guys, subscribe to our channel. You will be the first one to know when a new video arrives. So, okay, August 14th, drew $15,800 on its line of credit, receipt number 912. So here, August 14th. A line of credit is increasing our cash. And then, debit cash, document receipt 912, debit 15,800, and credit line of credit also 15,800. Line of credit, a current liability, a short-term liability here. So we can use this money when we want. So our cash payments journal, no cash payments journal because it is not a cash payment here. So let's go. The second one, promissory note, another current liability, another short-term line of credit. Sun Treasures signed a 60-day 12% note to Hess Inc. for an extension of time on its accounts payable. So, on September 30th, we are, under quote here, paying our accounts payable with a promissory note. So, we are swapping our liability. So, we will debit accounts payable and then our memorandum 142, 4,200, and credit notes payable 4,200. So we will decrease our accounts payable on the accounts payable journal and then notes payable now. However, what happened when we pay a promissory note? So we pay principal plus interest, and interest incurred on borrowed funds is called interest expense. Expenses that are not related to a business normal operations are called non-operating expenses. So, let's come here. November 29th. Paid cash for the maturity value of September 30th note, on this note. So 60 days, September, October, November. October 31 days, so November 29th. So if we pay it, our credit will be cash. How much? We are paying the sum of principal plus interest. Because our principal 4,200, the same principal here, plus $84 on interest. How do we find this 84 here? Principal times interest rate, 12%, However, this 12% is per year. All our interest rates are per year. So we don't want 1 year, we want 2 months, or we don't want 360 days, we want only 60 days. So here we are working with days, so divided by 360 days, that is our official number of years for interest, times 60. It is the 84. Now we debit the notes payable with the check number 751, 4,200, and we debit interest expense. That is the difference between cash payment and the notes payable. So it is a debit 84, and now our debits and credits are matching. And then the cash payment journal. Now we have it. So the day, 11/29, and here, what do we have? Promissory note, check number 751, and we are paying on debit 4,200, and also interest. We are paying the additional 84, and on cash credit, the sum of both. Okay, guys, that is not the hardest topic on earth, so that is a nice topic here and quite easy. But if you have questions or comments, just email me, jscarping@gmail.com, or write it here and watch this video how many times you want. Thank you so much. Have a very nice day, and God bless you.